Welcome to Pest Control Unlocked. I'm your host, Konstantin Schwartz. Before we dive in, my standard disclaimer. I currently hold no stock in Ecolab, Rollins, Rentokil, or any other publicly listed company servicing the pest control industry. I am a former employee of Rentokil, and any information I share regarding these businesses is based strictly on publicly available data, such as earnings calls and annual reports. The opinions expressed on this show are entirely my own and should not be construed as investment advice. All right, let's do it. In our last episode, we looked at Ecolab and their aggressive expansion into digital pest control. We saw a company executing a massive tech-driven strategy. Today, we're analyzing the latest fourth quarter and full year 2025 earnings of one of the most consistent operators in the industry, Rollins. I'm sure that many of you have heard the saying, culture eats strategy for breakfast. You can have the best technology roadmap in the world, but if your people aren't aligned, it falls apart. If Ecolab is optimizing the system around the technician, Rollins is optimizing the technician inside the system. Rollins is quietly proving that a relentless focus on company culture and employee retention is a financial superpower. There are three major headlines you need to know today. Rollins crossed the $3.76 billion revenue mark, achieving double-digit growth despite Mother Nature throwing a wrench in Q4. They are proving that culture eats strategy by turning employee retention into a literal $10 million profit center. Their M&A machine, highlighted by the Saela acquisition, continues to overdeliver. Let's take a closer look at the numbers. First, the scoreboard for fiscal 2025. Rollins delivered a solid year, achieving robust revenue growth at 11%, bringing total revenue to $3.76 billion. Organic growth was strong at 6.9% for the year, while acquisitions drove the remaining 4.1%. They also delivered an adjusted EBITDA of $854 million, up 10.8%. Free cash flow grew by 12.1% to $650 million. But we have to talk about the fourth quarter. It was a tougher finish to the year. Q4 revenue grew by 9.7%, with organic growth at 5.7% across all services. Why the slight deceleration? The erratic early winter weather. Extreme cold in the Midwest and Northeast severely hindered demand for one-time projects and made it difficult for technicians to safely service the demand that did exist. As a result, revenue from one-time business declined by almost 3% in Q4, a sharp drop compared to the 4% growth that segment saw through the first 9 months of the year. But here's why investors shouldn't panic and why independent operators need to take notes. Rollins separates its business into two buckets: the one-time transactional work, which is about 15% of the portfolio, and the recurring and ancillary services, which make up about 80% of total revenue. While the one-time business shrank, the massive 80% core of recurring and ancillary revenue actually grew by over 7% organically in Q4. The underlying markets remain healthy and customer retention is strong. They are treating the Q4 weather impact as transitory, firmly anchoring their 2026 outlook to 7 to 8% organic growth. Let's pivot from the top line revenue to the bottom line, because this is where the contrast with Ecolab becomes so striking. In 2025, Rollins prioritized a theme of getting better as we become bigger. In the pest control industry, 2/3 of your costs of services are people costs. It is incredibly expensive to hire, onboard, and train new technicians, only to have them leave shortly after. Rollins recognized that extreme ramp-ups in hiring drive higher turnover rates, which ultimately yields a suboptimal experience for the customer. So they focused heavily on their culture. They work to improve retention for newer teammates, specifically those who have been with the company for 1 year or less. The results? Retention in this specific category improved by approximately 8% in 2025 and has improved nearly 18% since 2023. What does an 8% improvement actually mean in dollars? Management noted that this resulted in having to hire about 600 fewer people year over year. When you factor in onboarding costs of $10,000 to $15,000 per person, that translates directly to between 5 to 10 million of operational savings. Let me just repeat that. Better retention didn't just improve morale, it created up to $10 million in profit. While Ecolab is focused on rolling out 1 million smart devices, Rollins is rolling out a program called the Ecolab for all people managers. The foundation of these sessions is servant leadership. designed to enhance personal and team development. But what does servant leadership actually mean in the pest control business? It means flipping the traditional corporate pyramid upside down. It means training branch and regional managers to stop acting like traditional bosses and start acting like coaches. Instead of just enforcing quotas, the manager's primary job is to ask the technician, what roadblocks can I remove for you today so you can do your job better? This isn't just soft HR buzzword, it's a hard financial strategy. Rollins knows that turnover in technicians is directly tied to turnover in customers. If a technician feels valued and supported by a servant leader, they stay. And by keeping their team stable and building that culture, Rollins protects its recurring revenue base. Finally, let's look at their growth engine outside of organic sales, and that is M&A. In 2025, Rollins executed a balanced capital allocation strategy, deploying over $880 million of capital. They completed 26 tuck-in deals, but the crown jewel of the year was the Saela acquisition, which closed in April. Saela is performing exceptionally well, exceeding expectations. Saela contributed upwards to $16 million in revenue in Q4 alone and $55 million year to date. Looking ahead to 2026, Rollins expects acquisitions to add another 2 to 3% to their revenue growth. They have a robust pipeline and the balance sheet to execute. Their leverage ratio stands at an incredibly low 0.9 times. They are generating cash at a staggering rate, with a free cash flow conversion of 137% in the fourth quarter and 123% for the full year. They are using that cash to not only buy companies, but to reward shareholders, having raised their regular dividend by more than 80% since the beginning of 2022. So, what is the strategic verdict on Rollins for 2026? Rollins continues to demonstrate that consistency, culture, and recurring revenue are a durable competitive advantage in this industry. They proved this year that even when extreme weather knocks down their high margin one time sales, their 80% recurring revenue base acts as an impenetrable shock absorber. They convert cash at well above 100%, keep their leverage under one time, and they have proven playbook for buying and integrating large assets. Look closely at their better before bigger strategy. Ecolab showed us the power of a technological strategy. Rollins bets on culture eating strategy for breakfast. Rollins is actively tracking the retention of first-year technicians and tying it directly to customer churn. If a multi-billion-dollar giant is hyper-focused on how they onboard, train, and apply servant leadership to the person holding the spray rig, you need to be too. Furthermore, they are pushing hard into ancillary services, things like wildlife exclusion and moisture remediation, which grew at mid to high teens and provides excellent cross-selling opportunities. You cannot rely purely on one-time calls or fancy software to build a resilient business. You need the recurring base and you need the culture to sustain it. Now, to be clear, culture doesn't scale infinitely without systems. And as Rollins grows, the question becomes whether human-led consistency can match the efficiency gains that technology platforms are targeting. That's the download on Rollins: double-digit revenue, earnings, and cash flow growth, anchored by an unshakable core. This is Pest Control Unlocked. I'm Konstantin Schwartz. Thank you for listening.